Hey everybody, this is Jim at sp500chart.com. It's about a little bit before 3 o'clock on Sunday afternoon, July 19th, 2015, and we're going to take a look at the S&P 500 chart after I remind you that the website and this video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I control lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I am not a licensed financial professional. I'm just a guy who draws lines on charts. So let's take a look at the past week. And in order to do that, I think we need to put this in a little bit of perspective. We got a few trend lines here that I think are fairly important. The first one is this descending trend line that had 1, 2, 3 pretty clear areas of resistance. We had a temporary break over that line that did reach 1%, but not much more. And then we had all of the wheels come off, at least for a while, for about 2 weeks, as Greece was trying to figure out what they were going to do to come to a deal with the European Union on their status with the euro. And basically, I'm not an economist. All I can tell you is you can't spend money you don't have for too long before something bad is going to happen. That's true of Greece, that's true of Portugal, that's true of Italy, it's true of Spain, and it will someday be true for the United States of America. But apparently the markets liked what they heard in the way of Greece backing off a little bit on their demands, and it appears that perhaps there's more hope now than there was a couple weeks ago. So anyway, this line we are now over by easily a technically significant margin. Therefore, this line would be considered support. However, I'm not really of the opinion that well, maybe I shouldn't say that. I'm not thinking right now that this line necessarily gets back tested, because if so, it would mean the markets would give up 2.5–3% in order to do so, and I'm just not seeing that at this point in time. Famous last words. Watch us open up with a 50-point gap down tomorrow. But if so, this line should give support. Finally, not finally, but also additionally, we had this little line right here that we were looking at for a while with the idea that we may be forming a bottom pattern here. We broke out over that on Monday, and we with that breakout, we established a target of 21.22 to 21.23 based upon the depth of this target. Think of Newtonian physics, if you will. For every action, there is an opposite and equal reaction. So if you pull the string back, the spring back this far, then when you let go of it, it will want to release that energy in the opposite direction. Obviously, a spring is a mechanism that also involves friction and internal components of elasticity and other issues. So you don't get that 100% reaction, but the markets are a little bit different. You often will see almost once you establish that area of, I don't want to call it middle ground, but let's call it an area of support or resistance that has not been crossed, or that the market is having a hard time crossing. Once you get over that, that tends to result in a move equal to the distance of the move on the other side of that line. That's why head and shoulders patterns have a minimum target that is equal to the depth of that pattern. Now that doesn't always work out. We could go back into the earlier part of June and see what looked to be a very nice little double dip here, and it looked like we were breaking out over that level, but then we fell back. And again, I think that was likely due to the fundamental issues of what was going on in Southern Europe. So, as we looked at this week unfold, there were a couple things that we did. The first thing was we were able to establish, I think fairly easily, where a rising resistance line is. We had to wait a little bit on the rising support line. I don't think we need to wait now. I think we have that, and it's right there. However, because we have now made our minimum target with both the end of the day action on Thursday and all of the action on Friday, we cannot look at this chart now and say we have an expectation that we are going to reach some level significantly above what our minimum target was. Keep in mind, when you use the term minimum target, that doesn't mean the maximum target. That means that's where we expect the market to at least achieve. So far, almost all of the inverted head and shoulders patterns that we have seen in the S&P over the past 6 years have been exceeded. Most of them, or a lot of them, reached the minimum target, then started to encounter some resistance. It would not surprise me one bit if that is what we see this week. And let me show you what that setup might be looking like. Here is our line where I'm expecting some resistance. We are right at that line. You will recall that we have seen in the past years a number of patterns that started with a left shoulder, a head, and then a very, very short-lived or almost non-existent right shoulder. You could make the case that that is what we saw in late June and the first week of July. Left shoulder, head, no right shoulder, breakout. Could we be looking at the same thing here? You know, I'm not going to rule that out. All I will say is this. This is the line of resistance. If we back up a bit, firm up, then come back to attack this, then you could easily see how this probably should be interpreted as an inverted head and shoulders continuation pattern. Okay, and it would look like this in the bigger picture. We move up, encounter some difficulty, consolidate in the form of an inverted head and shoulders pattern, then move up. If that is what we're doing, then we can measure, we'll just kind of pre-measure our target. If that's okay with you, I want to caution you. This does not mean this is the pattern. What this means is we keep an eye on this, and if we see the development of a right shoulder, short or typical, making it symmetrical, or even like we just saw, a willingness for the S&P to dispense with the idea of forming a right shoulder for whatever reason. If that's what we get, if we break over this line, I think we measure it the same way. So let's say we meander a bit for, let's say 3 weeks. Let's say we spend the next 3 weeks just sorting things out, trying to decide if we need to pull back or if we're ready to move ahead. And then let's say we break out in the second week of August. We would have a target then of about 22, almost 2210, which I think is a pretty good gain. So, again, to caution you, this is not a prediction, The chart is still in development. This is still, for those of you who are old enough to remember Captain Kangaroo in the early 1960s, mid-1960s, and his magic drawing board, we're just watching the drawing magically appear a little bit by little bit every day. And eventually we will get enough information to know, is this an inverted head and shoulders continuation pattern under development, or is it something else? If it is an inverted head and shoulders pattern, then I would be looking for support around perhaps this blue line, though we did get underneath it for 3 days in the previous week. That might give us some support. This line could give us some support. For sure, this line should. So I cannot tell you because of these different lines. I cannot tell you which one is the best candidate for support. I think probably this one, but obviously if this one's going to get tested, we would have to come down through some of these other lines that could also give support. So it's not a super clear picture where that right shoulder might bottom out. It probably should not bottom out any lower than where we saw the left shoulder hit bottom at around 2072. So if we do see some weakness, just on general principle, I would expect it to not be as deep as 2072, 2071, heck, call it 2070. So now let's look at a 5-minute chart. I told you that we were having a little bit of a hard time coming up with where we might place a rising support line in a channel. That has been solved, but I don't think it'll last long. I really expect the S&P to be turned back here. I could be wrong, but if I'm wrong, it would only be because my expectation is to see some kind of right shoulder dip. Again, we did not see it on this previous pattern. Right, well, where is it? Let me go to a 30-minute. We didn't see it here, but maybe we see it here. I would personally feel better about this pattern if we do see some selling of 1.5% to 2% or so this week. I would feel better about the health of a little pullback at this point. But again, if we get over this line without benefit of that pullback, and we get over it by a technically significant margin, then I think we make the call that we are looking at a 2210, 2209 target, which would be a clear departure from this range that we've been stuck in for almost 7 months. Okay, again, let's take a quick look at that 5-minute chart. You can see we moved up on Monday, consolidated, moved up again, came back for a little test of some support, broke up nicely on Thursday, again on Friday. Friday was fairly much a flat day, but what's a little interesting is the fact that we came up to our neckline area, turned back a bit, and then finished the day with another move to that line. So I'm open to the idea that we could move above this, but a chartist would be lying to you if he said this line is not resistance. It is. I believe we eventually get over this line, but I cannot tell you if it happens immediately, if we get a short little right shoulder, or if we get a more typical right shoulder that is in proportion to the left shoulder, which means a breakout above this line could take a number of weeks, and we could be in for some weakness until that fully develops. So guys, I think I believe that's all I've really got to share with you today in the way of the weekly review and looking back at what happened on Friday. I think we're in a potentially bullish setup. I am looking at this as a potentially bullish setup, and my money is where my mouth is on that as well. So what would it take for me to change my mind that this is not bullish? Well, at this point, it would take us plowing down through support, and it would take really us setting a new low that is underneath that 2043, 2044 low. So that could call this entire pattern into question. So let's go into this week with an open mind, but with a little bit of advance notice that maybe we're dealing with yet another inverted head and shoulders pattern. And if we are, and we end up breaking out over it, then we got a nice target of 2210, not 2020. What was I thinking? 2210. And just for jollies, we've got a rising line up here that has been fairly long-term resistance, as you can see here on the 4-day chart. It would be nice if we could see the S&P actually reach up for that line. Finally, I just want to throw out one more thing. We've talked about this whole bull run since March of 2009 and how it has taken on a shape of a rising wedge. I just want to remind you that rising wedges definitely have eventual, I don't know why I can't grab that little handle there. There we go. Rising wedges carry with them a bearish eventual implication. The apex of any wedge pattern tends to be quite important, as it often shows you where an important level is located on the chart. In this case, we have an intersection. That's hard to exactly pinpoint, but I'm going to say it's a little over 2,500, maybe even as high as 2,600. So there is the possibility that at some point in 2016 or very early 2017, we could be looking at this bull run lasting a bit longer. And I want to remind you, even if we break this line right here, and we flirted with it and almost broke it, we did not do it by a technically significant margin, almost did it 2 weeks ago. But if we break this line right here, there's a decent chance that we get a pullback rally, whenever that might happen, that could end up being something near the apex of this pattern. And I'm not, again, that's not a prediction. I'm just saying that is something that we see over and over in stock charts. I've seen it in descending wedges where you break out over the wedge and then you end up with a really nasty sell-off that takes you back down to that apex level. And from that apex level, there's then a shift in momentum to the upside. Well, in this case, we may break this line, pull back to that apex level, and then we learn that that's the top. So I am open to the idea that the S&P could eventually hit the mid-2000s. But after doing so, if it happens after a break of this line, that could very well be your market top. Speaking months, even potentially a year and a half to 2 years, well, not quite 2 years, but speaking maybe a year to a year and a half out of turn here. But as I look at this chart, I'm just letting you know what I'm thinking. I'm open to that eventuality, and I think it would make sense from a charting standpoint. So let me stop talking so much about the distant future and just reiterate our line up here is resistance. If we get over this, then we're looking for the S&P to put on close to 100 points. So we're looking at about a 4 to 4.5% gain after a breakout over this resistance line right here. I would love to see a right shoulder, then the breakout, but we don't always get what we would love to see. Hey everybody, thanks for watching. Thanks for your support. Be sure to check every day for the video that will come at the end of every day's close. So hey, thanks again. Take care.